Hi everyone, Joel here from Solace Financial with the Solace Investment and Economic Snapshot for January 2026. Let's jump into what moved markets over the past month and what it means to investors. January was a positive month overall, but it wasn't smooth. Geopolitical tensions and shifting expectations around interest rates created a lot of intra-month volatility, and we saw some big rotations within the markets. The standout performer was gold and precious metals, which surged strongly thanks to investor demand and ETF flows, even after a sharp pullback on the very last trading day. Emerging markets also had a strong month, supported by the weaker US dollar, increased investment flows, strength in local semiconductor manufacturers. In the US, money rotated towards energy, materials, and industrials, while the big AI trade paused, a little as investors waited for more evidence on earnings growth. Here in Australia, the ASX All Ordinaries rose 1.26% in January, but the gains weren't evenly spread. The market was really driven by just a few big resource names. The resource sector dominated thanks to higher gold prices, strong copper and industrial metal demand, and geopolitical uncertainty, which was driving buyers towards inflation hedges. On the flip side, interest rate expectations pushed up bond yields, which weighed on interest rate sensitive sectors like technology and property, being REITs. The small cap sector did well, especially resource focused companies. Globally, equity markets were modestly higher, but the big story was inflation. Inflation in the US and other developed economies was hotter than expected, which pushed government bond yields higher. That made investors a bit more selective, favouring value and cyclical sectors like energies and financials, and avoiding long-duration growth stocks such as technology. The US indices also posted gains, with small caps performing particularly well, and the Russell 2000 index was up more than 5%. Emerging markets led the pack, with a return of almost 9%, helped by AI-related supply chains and more supportive policy settings in China. In commodities, gold was a big mover, up 16% for the month, driven by momentum buying and safe haven demand. Oil also climbed more than 12% due to geopolitical risks in Venezuela and Iran, production outages, and tighter US restrictions on Russian oil. Bond markets in the US and Australia shifted towards a higher for longer interest rate view. In the US, strong labour and inflation data pushed the 10-year Treasury yield up to about 4.26%. In Australia, higher than expected inflation data prompted markets to reassess the chances of an RBA rate cut, many now expecting the next move to be a rate hike, not a cut, which it was. Inflation has proven sticky. In Australia, annual inflation is now 3.8%, up from 3.4%, driven by electricity prices, rents, construction costs, and rising prices for many services. This makes a quick return to the RBA's 2 to 3% target range very challenging. Labour markets remain strong, both here and overseas, which further reduces the likelihood of rate cuts anytime soon. So what's the outlook? Well, looking ahead, global growth should remain resilient, but it's going to be a little bit below the long-term trends. Corporate earnings will be the key driver for market earnings this year, and AI remains an important long-term structural theme. Early signs of revenue growth are emerging, but markets want clearer proof of durable earnings in the AI front. In the short term, expect continued volatility as markets respond to geopolitical inflation data, interest rate expectations, and corporate earnings. The key theme for investors remains the same: stay diversified, stay flexible, and stay focused on the long-term strategy rather than short-term noise. That's the January 2026 snapshot. If you'd like a deeper breakdown and discuss what it means for you and your portfolio, feel free to reach out. Until next time, we'll be watching.